Federal Deposit Insurance Corporation is transferring deposits and assets of those who are affected to a new bank. All of this has a lot of people nervous about their own deposits. John Marske is a certified financial planner who works with clients at Triad Financial Advisors, and he joins us to kind of boil down what happened here and make it easier to understand. Good morning to you.
Good morning, Brad.
So we talk about banks and being solid, or, you know, in this case, being in trouble. What caused these banks, I guess, to be in trouble?
What happened last week was basic run-on-the-bank scenario, and it was caused by three factors. A changing economic landscape with the Fed raising interest rates.
Which it has been doing.
These banks catered to very specific niche markets. Silicon Valley Bank catered to venture capital firms and startup tech firms, and Signature Bank, more crypto-related firms. So between rising rates, the markets that these banks catered to, and then just bad management, bad risk management.
So these were two specific banks in specific situations. What about people who are watching now and say, I've got my money in a bank that's either locally owned or maybe a national bank, and do they need to be concerned when they see something like this in the news?
It's important that everybody understand what FDIC insurance is all about. Number one, it's an agency of the government, but its money is not government money. It's an insurance company that's basically funded by the banks, and they will protect all depositors up to $250,000 per customer per account, meaning that one customer, if it's a married couple and have a joint account, they're basically guaranteed up to $500,000. These banks got in trouble because they had large customers that were way over that deposit minimum.
Which happens, I guess, with certain businesses. They're over that 250. But as I understand, they're still going to be at least covered, the depositors. Now, the investors in the banks, that's a different story. But even the people who had money here, they're still covered, right?
That's exactly right. And that was an extraordinary measure that the government took, basically covering people over 250, just again to assure the public that the government is not going to let their deposits fail. As you said, investors in the bank, they will lose a lot of money.
Mm-hmm. Is this, I guess, substantially different from what happened in 08, right?
It is, and 08 was all about asset quality. Basically, what the banks had on their balance sheet were bad mortgage loans, poorly underwritten mortgage loans, and when people wanted to take their money out of the bank couldn't sell those loans quickly. In this case, the banks had very safe treasury bonds, but the problem was, again, because interest rates have gone up so much over the past year, the value of those bonds went down. And so basically when the bank had to sell the assets to assure the depositors get their money, they were selling the assets at a loss.
So again, if somebody is watching this or they're reading all these stories online, do they need to be worried about what they've got in the bank? You know, we're talking life savings here.
Right, and again, I would just emphasize the FDIC insurance. The majority of people are protected, and there's ways you can basically get more than $250,000 in a bank if you title the accounts differently, and we'd be happy to help people with that as far as how to title them. But again, the banking system is safe. It's not like 2008.
Okay, John, that's what a lot of people needed to hear this morning. We appreciate your time and your expertise. Thanks.
Okay, thank you.
Well, today is March 14th.